Okay, so very good morning. Welcome to the briefing then. And taking a look at what happened yesterday was quite a big sell-off really in the equity market that happened very much at the beginning of the European session, then also the beginning of the US session, which continued until around 6 p.m. last night before we took a bit of a bounce towards the late few hours before the close on Wall Street. And what's been quite interesting, I think, about the market moves in the last 2 days is that there really hasn't been one big headline that's driven the moves. It seems to be just the fact that after the stress tests, the situation of European banks, it seems, has started to really capture a bit more attention on a global front. Now, I've talked about this a few times before, but I think the human behavioural element of the markets I find quite fascinating, because it's only when you get a big event, like say the stress tests, and it identifies such weakness to multi-billions, if not double-digit billions, of holes in banks' balance sheets as per the Italian banks, that then the US start to pay attention to the situation here in Europe. It's almost as if the US have been so focused on the Fed, won't they hike rates, that they've not really paid too much attention until those stress tests came out to the Italian banking situation. And for one of the first times yesterday, I've started to hear on likes of Bloomberg TV and on Twitter more and more US people looking at this dire situation of Monte Paschi in particular, but also other Italian banking names. And what that means then is that you start to see a bit more weight come into the moves. So before, if you remember, we were seeing kind of big sell-offs in the European Open, but generally speaking that was not occurring in the US session. However, that now seems to have changed slightly, that dynamic, in the last day or two. The other thing as well, just weighing on general sentiment on that regard, is continuing fall in crude oil prices. Now, one thing that we have seen is after the very disappointing US GDP that printed at 1.2% with that first look at second quarter growth, which was much lower than expectations, that in combination with the fact that the Fed already somewhat concerned about inflation remaining low, well, its growth is already weak, and then you've got the likes of oil is going to pressure further inflation to the downside. Then you've got data coming out really showing the weakness of the UK economy, so you've got an external risk as well, which is becoming more factual. Then certainly the ability for the Fed to hike rates is somewhat diminished then for this year. I think for September we're tracking around 17% and for December 30%, so certainly it's not priced in for this year. And the dollar weakness would suggest that you've kind of got an economy that underlying is let's say moving along at a fairly okay pace on some regards, but these external risks, the inflation aspect, is quite worrying, and that's going to put all the more pressure on the job sector, which has been fairly robust, but non-farm payrolls obviously is due this Friday, and I think that's going to be really key. If that number comes in low, then certainly a Fed hike is definitely off the table for this year. But just taking a quick look at various assets first before we get into the news. We had a lower close on Wall Street last night. I did see a stat for the Dow. So the Dow Jones Industrial Average finished down 0.5% yesterday. That was the 7th day of losses for the Dow. The sequence of falls last extended to 8 days. You'd have to go back to the 2nd of August of 2011. So again, we've had 7 down days in the Dow, an 8th consecutive down day. You'd have to go back several years. Quite a pertinent statistic. But looking at the S&P for one, now let me just highlight a couple of areas. So this was the European morning when we first came into the markets. Remember, this is why that cash equity open is really key, because when that opens, that's when you start to see the pickup in volume and volatility. Then the open on Wall Street is here, and one of the key areas that was of significance yesterday technically was this 2152 level. If I just quickly flick that over to a slightly longer daily chart, 2052 is here on this level that had been holding up from mid to late July. You can see it was tested on the 27th, close to it, the days pre and post that date. And then you can see this big wick lower. When we broke that level yesterday, that was technically significant. We then went to the next kind of line of support around 42.75 before bouncing. But this morning, we're already under pressure again. So I'll just be looking at that 42 3/4 level and yesterday's low print, which came in just below there. That was down at 41.5 with the S1 sitting at 39. You can see then that 52 level yesterday, it broke, stops run, hit the S2 level, bounced back, and then it would a wave lower into the European close at the time. Now another factor that's been weighing here has been crude oil prices. Now crude this morning, you can see, is trading pretty much unchanged, slight loss of around 7 cents. We're trading 39.44. Quick look firstly at that price action. That's the release of the API crude oil inventories last night. When that came out, we saw a spike higher. So that wick that you can see with the initial high print seen of pretty much the late evening and overnight session was seen up at around 39.89. Why did that occur? Well, let's have a look at the numbers. Here are your API numbers. Again, this is tracked over the weekly DOE performance. So what you're looking at here is the blue numbers of the APIs, and the last green with the figure is the last DOE figure that came out last Wednesday. So looking here, the biggest kind of change and the one that drew attention was the Cushing number. You can see here a move to the downside. That number was a draw of 1.3 million. Expectations were for a build of 1 million. If you remember Genscape on Monday, that showed a fairly benign reading of around a draw of 59,000. But the Cushing number last night was a draw of 1.3 million. That would be the number to watch when we get the Department of Energy numbers later. The actual headline reading was a draw of 1.34 million. Not too far from consensus though. That was expected to be a draw of 2 million. So the Cushing figure was bullish. That's what caused that initial pop. However, the overall data set not massively bullish as a whole. As I said, the drawdown in crude slightly less than expected, and distillates was a build of just over 500,000. So net, a bit of volatility, but no real sustained direction. The direction at the moment for crude, looking slightly longer dated here, certainly has been fairly convincing since we peaked at around the 8th, 9th of June, up at around 52.73. We've now fallen. This is about 25% decline here, from 52 down to around the 40 or just below there at the moment. Now 40 technically here, not too much of a level, but psychologically obviously important. But as you can see from the price action of the last 2 days alone, we've already punched below there, and I'd be looking around that 38.67 low, which was the 4th and 5th of April low, as the next kind of point of support, potentially to the downside. Now, quite interesting to read some of the bank comments about crude at the moment. You know, we've been talking about the fundamental picture, the rig count, the kind of US output increasing, all as catalysts for downside, and now you've got kind of the reality of the fact that the global economy is slowing post-Brexit. That's going to have a knock-on effect on Europe. China's also slowing. And now US growth and demand is also being questioned after that very disappointing GDP. So there's a lot of downside catalysts, I feel, for crude from here on out. But banks remain a little bit mixed. So Morgan Stanley, they've said risks for oil remain skewed to the downside in the second half of this year. Supply disruptions and risk appetite were supportive in April and June. Remember, that's when we had that big ramp up in prices. But fundamental headwinds are growing, which outnumber any recent positives. So Morgan Stanley very much calling potential for further downside. However, other analysts, like Citi, they say that the recent price falls are overblown. Standard Charter, there's no fundamental justification for the recent oil price fall. Well, I don't know. I beg to differ with that. And I think that at the moment, the way that the market has moved fairly easily through that 40, I would think that there's potentially more downside here to come. That's definitely going to be crucial to watch from a Fed point of view for the knock-on implications that could have then on inflation in the country. Okay, quickly before I look on to some other charts, the DAX, you can see here, top right, already has fallen through that low from yesterday afternoon before we saw that bounce when US markets turned before the close. So already the DAX under a bit of pressure. Just having a quick scan of some of the service PMI data that's come out of Europe. These are final numbers, so not really too market moving. The Spanish number was a touch weaker. The Italians just come in 52 above the expected 51. A couple of earnings reports though to be aware of this morning. HSBC, they've announced a $2.5 billion share buyback for this year as the CEO tries to reverse a stock slump while backing away from an annual dividend increase. Their pre-tax profit at HSBC was down 45%. The banks also removed a target of surpassing a 10% return on equity by the end of next year, citing economic and political uncertainties, saying their goal remains appropriate. So, these banking stocks, much in a similar vein to the US, from a profitability point of view, still remaining quite under pressure. However, if you look at HSBC shares, they've been vying with Next as the biggest riser on the FTSE actually this morning, on the back of the buyback following the sale of their Brazilian business last year. So investors have kind of jumped on that side of things. HSBC, despite of that low bar that's been set for profitability, again, outperforming despite big drops in pre-tax profits. Next, I thought was quite interesting, not because they're a big stock, but because the UK high street is something watching closely at the moment for consumers' appetite to spend post-Brexit, or certainly in the late June-July period. And UK's second largest clothing retailer said that sales accelerated on new store openings, and it sharpened its sales and profit forecast for the year. So actually, they're performing quite well at the moment. The one thing is though, let's take a look at the pound. It's a big day for the pound today because we get the final piece of the puzzle, so to speak, with the service PMI number. Before that though, a couple of news stories overnight related to the UK you should be aware of. For one, NISA, the think tank, they've commented overnight and report that Britain's economy will shrink this quarter and has a 50% chance of suffering a mild recession before the end of next year, purely down to Brexit. Separately, the British Retail Consortium, known as the BRC, they've said that British shop prices declined at the slowest rate since August last year, according to an industry survey. Tentative signs that price pressures may be building since June's Brexit vote. So shop prices declining would suggest then lower inflation. Maybe that needs to be stoked by likes of QE. That then coupled with the underlying economic weakness, with the fact that we've got an increased chance of a recession occurring as soon as later this year. This then comes into the data that we're looking at for this morning. And where we're sitting at the moment in cable has been quite interesting, because yesterday we had the construction PMI coming out of the UK. Now, to remind you, let's just take a look at that figure, because sterling actually rallied when this came out. So just try and make this a bit bigger so you can see the full chart. You can see here that construction in the UK was the lowest reading since June of 2009. So we fell here lower, or historically one of the lowest readings we've had in some time. However, it was not as bad as expected, and as I said, sterling actually rallied on the back of that. However, the lowest level since the financial crisis in terms of construction in the UK. This obviously comes as well, having this week already seen the manufacturing PMI was the lowest reading since February of 2013. Now, looking at that on a chart, that looks slightly more worrying when looking at this economic trend that we've had. So the data in manufacturing had contraction in both levels of production and new incoming orders. Now, this then sets us up for the biggest number of all, and that's the service PMI we get for the UK at 930. This is going to be a big one for the pound. Now, this is a chart from the Office of National Statistics, the ONS. And what I wanted to do was graphically show you the importance of the service sector compared to production and construction, what we've seen already. And you can see here that as a contribution to the country's GDP, the service sector, albeit this is probably about 2 years out of date now, but the same percentages still roughly apply, is we're heavily geared on the service sector. 78%. So despite the weakness that we've had in the data seen thus far, if we get a strong number today, then certainly I think that this could change the game in terms of the way that the Bank of England are thinking. Now, looking where we sit more recently, well, this is actually the Chinese figure. Let me quickly change this over. So the service figure, the last time we saw the report, we came in at 47.4. This is for the service PMI. That was in July of 2016 from 52.3 in June. So it was below expectations. The sector hit by the vote to leave the EU. This is from the market service PMI. So we've already started to see a bit of weakness seeping through. And when looking at cable and where we reside at the moment, we've managed to technically break above some of the recent range that's been containing price action, certainly since the second half of July. We've moved above the 133 handle. The question mark, though, is if this number comes out particularly strong, then does the Bank of England need to go with this three-pronged attack that the likes of Bank of America have been pushing in their research note earlier this week? They've been talking about the fact they could cut rates, restart QE of around 50 to 75 billion pounds, and then also look to reboot the funding for lending scheme. If though that number is weak, then I think that certainly is a viable option, given the context that consumer confidence is lagging, investment funds are seeing substantial outflows, so you want to be able to steady nervousness about foreign investment into this country, particularly because we run a negative current account. We are dependent on foreign inflows. And then manufacturing is weak, construction we know is weak already. So this number for me is really key. I think regardless, the Bank of England will cut rates. The question I have is, do they cut, or do they cut and do more? And I think that's why this number is very important this morning, because that will complete then the market's expectation of whether that will occur on a multiple targeted approach to the Bank of England tomorrow when we get Super Thursday. So be at your stations, regardless of whether you're trading sterling or not, just given the focus ahead of the Bank of England Super Thursday tomorrow, it could be a mover across asset class when that does come out. Okay, finally, just a quick look at the calendar for today. So the UK number, as I said, 9:30, but later on this afternoon, let's not forget, you get the various job indices now heading into non-farms. We've also got that on Friday. So ADP employment change, that's going to be a key metric to follow. That'll be at 1:15. Make sure you're at your desk in good time for that number. Get your lunch early. And then you got the service PMI at 245. The more important one, though, of ISM non-manufacturing composite. That has constituents which includes the employment section of that reading. So the ADP in combination with that employment constituent of ISM non-manufacturing will help put the final calculations together for expectations for non-farms. Then crude traders, as ever, likely to see a high degree of volatility around the release of the Department for Energy numbers. Again, we're already at fairly interesting levels now in crude on do we cement a clean break sub $40 handle. This could be a key catalyst. The numbers last night were slightly siding on a more bullish angle with a larger than expected draw in the Cushing number. So that's probably how the market's positioned. Anything other than a drawdown again in Cushing could well put some renewed downside pressure on crude. Speakers, you got Fed's Evans giving a press interview, but is a non-voting member, but is speaking over the open on Wall Street. So again, just to be aware of. Okay, that's your morning briefing. Enjoy your trading day. And UK data, next big event up in half an hour's time.